Good morning, traders. Matt Weller here, Global Head of Research with FOREX.com. Today is Wednesday, July 1st, 2026. We're officially into the second half of the year. We're on the eve of America's 250th birthday. We're also on the eve of the U.S. winning a knockout stage game in the World Cup. But most importantly for traders, we are on the eve of the non-farm payrolls report, the monthly jobs report out of the U.S., which will be released a day early due to the holiday. That will be released tomorrow, Thursday, the 2nd of July. And in today's video, I'll break down everything that you need to know ahead of that jobs report, as well as the other economic data that we've gotten so far today. Let's get into it. Quickly recapping some of the market moves we've seen over the last 24 hours, the US dollar continues to strengthen as we head into the second half of the year. Oil is falling by 1%, not a huge move, though notably it has essentially completely unwound all of its gains from the US-Iran conflict, and US indices are edging a bit lower ahead of the US Open. In terms of economic data, we got two appetizers for non-farm payrolls. Those were the ADP employment report, which came in a bit below expectations at 98,000 versus closer to 120,000 expected. Not an objectively bad report, maybe something that just keeps expectations more under control. And then separately, we got the Challenger Gray and Christmas labor market survey, and the key thing to focus on there are the number of layoffs. In this case, layoffs fell very sharply, got cut in half over the last month, down to closer to 45,000. So a bit of mixed news heading into the NFP report. More on the expectations momentarily. I'll just mention one more report we'll be watching today, the ISM manufacturing PMI survey. That'll be released at 10 o'clock Eastern time, is expected to show continued growth at 53.8, and the two subcomponents I'm going to be focusing on are prices, which are sky high at 82.1, at least last month. We'll see how they come in this month. And then we'll also be closely watching the employment subcomponent, which has been in contractionary territory below 50 the last couple of months. That was 48.6 last month. As for the NFP report, these are the key numbers that you need to know. 114,000 jobs is what traders and economists expect. They expect average hourly earnings to rise 0.3% month over month, and the unemployment rate to remain steady at 4.3%. If we get all of that, that's just a continuation of the resilient labor market that we've seen for the first half of this year. What could be different, though, is the Federal Reserve's approach to it. After the first Fed meeting under new chairman Kevin Warsh last month, traders are pricing in a more hawkish path of interest rates, and indeed are pricing in about a 1 in 3 chance, according to the CME's FedWatch tool, that we could see an interest rate hike not later on this year, but as soon as later on this month at the Fed's July meeting. I think those odds are probably a little bit high. I think it would take a really special cocktail of factors and reports to get an immediate interest rate hike. But the first of those that could come in is this jobs report. So keep a close eye on that. Unless it's a blowout number, I think those odds could fall. However, the broader perspective here is that it's a question of when, not if, the Fed will continue to raise interest rates, and a stronger than anticipated jobs report could accelerate those expectations. Today's chart of the day is the US dollar index, which you can see here had a big breakout above 100.50. That was in the middle of June. It's held on to those gains. Late last week, we did see a bit of a pullback, but it was very controlled, very shallow, and now we're back in rally mode, touching those highs that we were just trading at the end of June. The next level to watch, if this uptrend remains intact, if we do see a strong jobs report, is closer to 102. That's a major resistance level dating back to last year. Meanwhile, any dips, I believe, could be well supported. Even if we see a relatively weak jobs report, the bigger interest is on inflation. That remains above the Fed's target, and unless we see a dramatic change there, I think the US dollar will remain a buy the dips trade. The key support level to watch is that 100 spot 50 level. If that level gives way, maybe we call into question the dollar's uptrend, but for now, the technicals suggest to me that the balance of probabilities is to the top side for the world's reserve currency. That is today's video. Thank you for carving a couple minutes out of your day to watch. If I could ask just one favor before you go, please do drop a like on this video. It's a free way to show your support that helps us with the algorithms. And if you're not already, please do subscribe to our YouTube channel at FOREX.com for more videos like this. Also, one final quick programming note. This will be the last video of the week from me. That's because I'll be doing my NFP webinar tomorrow, and if you want to register for that, please do go to your local FOREX.com website. We'll be back again next week, so have a happy, healthy, safe, relaxing, fun holiday weekend for those of you in the US. Thanks again, and chat again next week.